Well, the Volcker Rule is something that is mandated by the Dodd-Frank Act. And the Congress, when they were writing the Dodd-Frank Act, was very unhappy with the idea that banks that had deposit insurance could take the depositors' money, which the government or the depositors themselves through the taxes they were paying was insuring, and then undertake risky trading with that money. The idea being that the banks would get to keep the profits if they made any profits, but if they lost all of the bank's capital and essentially went into receivership with the FDIC, the taxpayers would have to bail them out. So the Dodd-Frank Act wants to get risk-taking out of the banking system. One form of risk-taking is market making, where you're helping your customers by selling when the customers want to buy and buying when the customers want to sell. Typically, though, the risks in market making are quite small because the inventories that the banks hold are either hedged quickly or they're reversed very quickly. Proprietary trading, on the other hand, is when a bank takes a position, maybe the customer wants to sell, so the bank buys, and then the bank holds the position for some time, betting that the value of that inventory that it has acquired is going to go up. Now, that can be quite risky because the value of the inventory might go down. So the Volcker Rule basically says that if you're a deposit-taking institution with deposit insurance, you're not allowed to engage in proprietary trading where you're positioning risks in the bank's balance sheet for a long period of time. There are kind of two ways to limit banks' risk-taking in a manner that would protect taxpayers. One way to do it would be to have very high capital requirements so that the banks have a huge cushion to protect themselves against losses. And the cushion is not the depositors' money, but the cushion is the stockholders' capital in the bank. The Dodd-Frank Act did not go that way. The Dodd-Frank Act went the other way. They said instead of imposing very high capital requirements, we're going to impose a lot of regulations. So the Volcker Rule now has to define what is market making, because market making is helping your customers and it's presumably not that risky. And where do you draw the line between market making and proprietary trading? That line's almost impossible to draw. It's a kind of a matter of the intent of the trader when he actually does the trade. The London whale episode that JP Morgan got involved in, where they lost $6 billion, I think, was described by JP Morgan as being a kind of generic hedge of a sort of unspecified large portfolio of assets. And since that was described as a hedge, the Volcker Rule basically it wants to clamp down on that type of hedging and not allow it. So the banks, because of JP Morgan's misbehavior, are going to now be saddled with perhaps pretty burdensome regulations related to hedging. So let's suppose that the Volcker Rule is successful in getting risks removed from the banking system. Recall the alternative would have been keep the risks in the banking system but let the banks hold more capital. But now the banks don't hold more capital and the risks go outside the banking system. Well, where do the risks go? The likely place for the risks to go is into hedge funds. So hedge funds are going to be pools of capital that could otherwise have been invested in a bank's equity, but now will probably be invested outside the bank in limited partnerships that represent the risk capital for hedge funds. And so a lot of proprietary trading will go to hedge funds. My prediction is that the banks will develop fairly close relationships with the hedge funds. So now you might even expect the banks to want to own a hedge fund. Well, of course, this is another regulatory issue, and the Volcker Rule has to deal with that. And the Volcker Rule is going to say, no, banks can't just own hedge funds. Banks have to kind of keep their capital out of such risky activities as hedge fund trading. So the Volcker Rule is going to have complicated regulations that enforce something of an arm's length relationship between the bank and the hedge funds by saying that the banks can only use a very small amount of their capital to invest in hedge funds. Nevertheless, I expect that what will happen will be hedge funds will develop close relationships with banks. Hedge funds need what are called prime brokers to interface between them and the asset markets. And I'm suspecting that the very large prime brokers are going to have a big business and growing business dealing with hedge funds that are engaging in the prop trading that the banks would otherwise engage in.